All right, welcome to another episode of Map Your Money. I'm here with Jeff. And Jeff, been a crazy week with football recently. We got our Super Bowl is set. The Chiefs are back in it again. Chiefs versus the Eagles, a little rematch from 2 years ago. What would have been your thoughts so far? I know you called the Chiefs early when we were talking, I think, the beginning
Was
of
it
the
a year
year,
ago?
beginning of the season.
Yeah, I think it was a year ago around this time. Last year's playoffs were kicking off, and I said, you just can't count out the Chiefs. I don't think they were my outright pick, but I kind of threw them out there as somebody that's like, man, they're always kind of a sleeper that could take it. Have they lost since I said that? One game in the regular season? Is that it?
I think they lost 2 in the regular season.
All
Yes.
right. Well, I'm sticking with the Chiefs, man. I mean, their team is so good. They have so much chemistry. I think Andy Reid too is very underrated as a coach and uses a lot of his players' strengths and weaknesses, really well against the other teams. And the Eagles, they look good. It's going to be a great game. It was a great game 2 years ago, but I'm going to say the Chiefs for the first ever NFL three-peat. That will be something.
I know it.
And can I just say one other thing too? I'm a big Tom Brady fan, right? And so I think
I was gonna bring that
everybody
up.
talks about Pat Mahomes being the GOAT and how if he three-peats, he's obviously the GOAT. Well, in my mind, that means he's obviously the second GOAT behind the guy that he couldn't beat when the guy was still in the NFL, right? Tom Brady kept Pat Mahomes out of the Super Bowl several times as a Patriot. And then in his first year as a Tampa Bay Buccaneer, faces Mahomes in the Super Bowl and beats him 31-7, right? So, or was it 31-9? Yeah. So,
Yeah.
I don't know. I think Pat Mahomes winning this one further cements Tom Brady's legacy as a GOAT.
That's an interesting take. Definitely against the grain there, but I see your point. As kind of a hater of dynasties and just kind of annoyed with seeing the Chiefs, and before the Patriots. I know as a big Patriots fan, you can, I guess, kind of sympathize with us now, and now you see the Chiefs in it every year. It kind of gets boring year after year, I feel like, with the same team. Or are you a big dynasty fan?
I think people always say, may the best team win. And I think the Pats were the best team then. I think the Chiefs are the best team now. I think the best team keeps winning. And I think the refs, as much as they tried to help the Bills win that game, couldn't do it. Josh Allen can't even get, 1 foot, right, on a fourth down. I mean, come on.
Big Josh Allen hater. I won't let you go down that route.
How about you? Who's your pick?
I think I'd like the Eagles to win. They have a lot of UGA players on their defense, which is fun. But I don't know. I'm not a big fan of either of the franchises, so we'll see.
Those Eagles fans are they're wild. And I will say a lot of my friends back home in Arkansas, a lot of them are big Chiefs fans. So and they suffered for a while having not only just a bad team for a while, but kind of just a mediocre team that kind of barely missed the playoffs several years in a row. And they were kind of in this vicious cycle of not good enough for a good draft pick, not good enough to make it far in the playoffs. They were kind of stuck. So I'm happy that they've, used one of those draft picks pretty effectively, and now we're doing well.
Yeah. That's definitely one way to put it. But got an awesome episode for us here in kicking off January of the new year. So let's get right into it.
Hello, and welcome to Map Your Money, a finance-focused podcast. We exist to simplify the lives of our clients and listeners and to help individuals create the roadmap for their financial future. Calls are pre-screened and the content was pre-recorded. Please note that the content presented is for educational purposes only. We encourage you to consult a financial advisor or conduct your own due diligence before making any investment decisions. All information provided is believed to be reliable but is not guaranteed for accuracy or completeness. This presentation does not constitute investment, legal, or tax advice, nor an offer to buy or sell any security or insurance product. It also does not endorse any third party or their views. All examples are hypothetical and for illustrative purposes only.
All right, Jeff, I know you had some stats and information on housing. I have some info on retirement accounts, specifically Roth IRA and 401k. You want to go first, or you want me to kick it off?
How about I'll go first? And here's why. I think this is actually pretty important for a lot of people. It's something that a lot of people are watching. So I'll start this off with, what was the inflation rate at the end of last year? Right. So the CPI was just reported for December. The year-over-year inflation rate, what was that?
I'd say right around 3.4 would be my guess.
Yeah, 2.9. It's like right around 3. It's been around 2.53 for a while, right? And this is overall the headline inflation. So it's 2.9% overall in December. And what's interesting is people keep talking about that. They keep talking about how the Fed is, inflation's not at 9% anymore. That's where it peaked back in 2022, but it's not quite down to the Fed's 2% target. It's kind of been lingering around this 2.5, 3. And something that we've been talking about is the effect of shelter inflation on the overall CPI index, right? And so if you had to guess, of that 2.9%, what is the percentage points due to shelter? As in, how much did shelter inflation contribute to that 2.9%?
I feel like a lot. I'm gonna go 40% of that amount.
It's over half. It's 1.6 percentage points, right? So if you take out shelter completely, the inflation rate would be, take out the 1.6 from the 2.9. That's kind of dirty math, 1.3%, right? So really, if you think about inflation that way, it's shelter that's really pushing us beyond the Fed's inflation target, right? And I think this is like such an interesting thing as we go into what's causing the shelter price inflation. So as you alluded to, I do have some stats for you. The first stat from the Census Bureau is at the end of 2024, this was an estimate made in April of 2024, the U.S. would have a housing shortage of 3 million units. Okay. So that is the amount of new households that are being created, people getting married, people having kids, graduating college, whatever, minus the households that are, deforming, people, dying, passing, etc. The amount of those new households being formed relative to the new housing units that are being created, that's the shortage of 3 million. And this is basically going back to post-financial crisis. And a lot of that is because, number one, inventory is really low, but also just, the amount of construction that we had post-financial crisis really fell off a map. And so we were at about, 1.4 million new homes constructed post-financial crisis, and then it dropped after the financial. Nobody wanted to invest in housing during that time. Yep. We actually reached a peak of 1.7 million homes being completed. That's a monthly annual pace. Okay, so it's reported monthly, but they multiply it by 12 to get the annual pace. That peaked out in October of 2022. But something else is going on with affordability. I don't know if you knew this, but since the cheapest that homes have been on an affordability basis was basically January of 2021. And since then, affordability is down 47% to the lowest level since 1989. So housing has not been this expensive since basically the end of the 80s, as well as in the mid 80s at this point. So we're going on almost 40 years where housing is so expensive. And why is that? Well, housing is actually a factor of a lot of different things, right? We know that housing prices have definitely gone up. If you look at December of 2024, the median price for a new home was $427,000. Well, that was about $280,000 in January of 2021. But really, the biggest impact has been mortgage rates, right? So the 30-year mortgage rate in January of 2021 was 2.65%. And the most recent read in December of 2024 was 6.9%. Okay, so let's do some math, right? Yeah. I've done some math for us, right? Let's do some math on this affordability concept. So in January of 2021, assuming you're buying a house priced at the median, that's about $285,000. You're going to put a 20% down payment on that, and then you're going to mortgage the rest in a 30-year fixed rate mortgage at whatever the prevailing rate is at that time, 2.65%. In January, that payment is $1,203 a month. This doesn't include taxes or insurance. It's just P&I, principal and interest. But in December of 2024, you have $427,000 house. So the house is about $140K more expensive, and your rate is 6.9%. So now your payment from $1,200 is now $2,250.
Jeez.
Okay, so we have two different factors there that are actually impacting housing price, right? Same mortgage, same 20% down payment, but you have a higher price, so that means a higher mortgage balance and a much higher mortgage interest rate. But what's interesting is, let's say housing prices didn't change at all. December 2024, you go in and you buy that same $285,000 house that you could have bought in January of 2021, but you're still paying the December 2024 mortgage rate of 6.9%. Your payment is still $1,966.
Yeah, wow.
So this is a conversation I have with a lot of people, right? It's like, hey, Jeff, housing prices are going nuts. Like, should I buy a house right now? Should I wait? What's going on? I always tell them, hey, worry about the interest rate. The interest rate is what really matters, because if you look at the increase of that same mortgage payment since January 2021 to December of 2024, 73% of that increase is related to just the change in the interest rates, right? If it's just the same house, then actually that payment, so the same housing price, so $427,000, that's the median price in December of 2024. If we apply the January 2021 mortgage rate to that, the payment only goes up to $1,376. So it goes up about $150. Versus for the interest portion, it goes up about $760. Okay, so what is with all these stats? Why am I saying this, right? The Fed's whole job in keeping interest rates high is to try to tamp down on inflation and bring inflation back to target. Over half of the year-over-year inflation rate right now is housing. And most of the reason housing is so unaffordable right now is because of high interest rates. So in what way is the Fed stuck in this paradox of keeping rates high to battle inflation that is housing related, specific to, or 73% of, is interest rates? Now, I'm not saying interest rates are going to go back down to 2.6, and that probably won't happen. But if you look at it, mortgage rate around, 4 to 5%, that's pretty normal based on historical times. You can definitely get to a payment that's a lot more affordable. But I guess my whole point is we go back and forth, and I hear a lot of this back and forth about inflation and what the Fed should do. Should they cut or should they hike rates? And the labor market seems okay, so that should be thrown into the calculus. At the end of the day, what's really causing inflation to be so sticky is housing. And what's causing housing to be so expensive and unaffordable is mostly interest rates. And so the Fed is kind of stuck in this paradox of how do they manage to make housing more affordable while still showing that they're committed to bringing inflation down. I think it's a tough challenge, but overall we have seen some progress in this area, right? And inventory right now, it was about 880,000 in January of 2021. In September of 2007, it was about 3.9 million. And right now it's at 1.15 million for existing homes. And so what has happened is as interest rates have come down, mortgage rates have come down, people that bought houses and refinanced are now stuck in their homes because if they move, they're going to have to take on a higher interest rate. So all of this inventory has been removed from the housing market where, existing homes are about 90% of the market. New home sales have actually been increasing, but existing home sales hasn't because people have been staying in their existing homes. And so we have this kind of unique problem with the housing market right now that they're really expensive because of interest rates. And interest rates are also preventing the turnover in the housing market, which is keeping prices propped up, which is encouraging a lot of new construction. But then you have things like, construction wages are up 16% since January of 2021. A lot of building materials are going up. And so that makes housing more expensive. And in the face of it all, what do we have now? We have a new administration threatening tariffs on Canada with 85% of the lumber, more than 30% of the lumber in the US is imported, and 85% of that is from Canada. So I'll pause there and just kind of lay out some of the dynamics going on of the complexities of the housing market and why it's expensive and why maybe solving this problem isn't going to be as easy as some hope.
Yeah, no, I mean, it's very interesting to kind of compare the proportion of inflation that's accredited to housing, and then at the same time make the point that housing is so expensive because interest rates are high. So it is, like you said, a big paradox for the Fed in terms of what should they do in terms of bringing interest rates down. It benefits in terms of making housing more affordable, which would potentially bring that component of inflation down. At the same time could have adverse effects as well. So I think it's really interesting kind of where we're at. And I know a lot of people, especially younger people into the workforce, have definitely felt the grunt of housing prices being so expensive, or anyone looking to buy a house. And on the tail end, like you mentioned, people who've locked in lower interest rates aren't incentivized to leave their houses, even if maybe they were looking to eventually switch homes and switch their mortgage. Why would they give up such a low interest rate that they have now for what they could get in the market in the sixes compared to their potentially in the 2 or 3% range? So I think a lot of that,
I mean, you see it, like, even if you keep the price of the house consistent and just change the interest rate. So that's like kind of analogous to somebody that, has equity in their home and they participate in that appreciation, but they want to maybe go buy a bigger house or maybe upgrade, and they get that higher interest rate. I mean, you could be looking at a mortgage payment that goes up 50%. And the thing that's the most painful is it's just interest. You're not getting 50% more because there's an extra bedroom or a nicer bathroom or a garage. It's just interest. So I think it's interesting. And one more nugget on that is the shelter component of CPI. It's called owner's equivalent rent. And so what they've realized is they match it to like rents that we see on the ground, like from data sources such as like Zillow. And typically as rents start to come down, you typically see that OER, owner's equivalent rent, and the CPI start to follow it around 12 to 18 months later. We've not seen this happen perfectly, but we are seeing that trend is still somewhat intact. And so this OER component is it's decelerating on a year over year basis. And so it kind of offers this question for the Fed of, will you acknowledge maybe some of the complexities and nuances of the data you're using to make these decisions, and acknowledge that the forward-looking data looks like there's a lot of progress being made in this area? Or are you going to stick to the cold, hard numbers that come out every, second Wednesday or second Thursday of the month when the CPI comes out, and trust those numbers, right? And I think that's where a lot of the disagreement on what the Fed should do really lies, is the people that understand the inflation that we're seeing in CPI is really just kind of inflation that we've already on the ground had to endure, and not really representative of the inflation that we're currently enduring now. So
so if you were in
something fun
Jay
for
Powell's,
our listeners to think about.
So if you were in Jay Powell's seat, and I know it's a tough seat to be in, would you propose cutting rates faster than they currently are?
So right now it looks like they're going to cut 2 times this year, and then they might be done. That's kind of what's priced in, is they're kind of done for the cycle. Which that implies is that our neutral Fed funds rate, the rate at which we're not helping the economy or dampening the economy, that's around 3.75 to 4. That's 50 basis points lower than what we are now. I would say that's quite a bit higher than where the Fed originally thought neutral was, based on a 2% inflation rate, which was closer to 2.5, right? So they've actually moved up quite a bit. I would be trying right now, if I were the Fed, to get rates to neutral basically immediately, right? I think that inflation really was a COVID story, because COVID created the supply chain issues, and then COVID also created the conditions that necessitated a lot of the fiscal and monetary response that we put into the economy. And a lot of that really has dissipated, and we've seen inflation dissipate, and we've now seen a lot of different measures of the economy, including inflation, kind of running at where we think they should be overall. So I think that means the Fed should go ahead and cut rates to neutral, and then let the economy play out as it should. And some of these other factors, they'll oscillate, but I think they'll settle out where they should. And at some point, you have to get rates down to a level where housing is more affordable, and that is going to incentivize builders to build more housings, because then people will be able to buy it, which I think will take care of the issue. I mean, at the end of the day, the best solution for high prices is high prices, because they incentivize more supply.
Yeah, no, it's a good way of putting it in. Kind of a lot of people, when they talk about inflation and ask like what's the best asset class to hold in high inflationary periods, it's stocks, because that's
bingo.
They're taking advantage of the higher prices as well. So
you want to own nominal assets. That's it. You just want to own nominal, so it's like, well, if inflation happens, the price of a loaf of bread is going to go from $1 to $10. Like, okay, well, what's the price of a bread manufacturer then? What's the price of that stock?
Mm-hmm. Yeah,
probably pretty good. That's the way you got to think about it. Own non-dollar, own non-currency assets. Stock is one of those assets.
Definitely. Well, want to switch gears. Had a couple things on retirement accounts that I think is valuable to know for 2025. I know with people who are making Roth contributions or interested in Roth IRA contributions, the beginning of the year is always a really good time to make these contributions, because you have the ability to make contributions for 2024 all the way up until the tax filing deadline. So you have until April to make those contributions. And then you can also make your 2025 contribution, of course. And so that contribution max didn't change. So for 2024, it was $7,000. If you're over 50, it's 8,000, and for 2025, it's the same. So 7,000, and then over 50 catch up is 8,000. One thing I like to touch on there is to make Roth contributions. You have to be under a certain income, and so if you're married filing jointly in 2024, you need to be under 230,000 combined. Or if you're single in 2024, you need to be under 146,000. For 2025, those increased a little bit. So married filing jointly up to 236. If you're under that, you can make your full contribution. And if you're single, if you're under 150,000 in income, then you can make that full contribution. If you are over those amounts and want to still contribute into your Roth, you still can. If you do not have a traditional IRA account, then you can do what's called a backdoor Roth contribution. You can contribute this money into a traditional IRA. You take that money from the traditional IRA and you roll it into the Roth IRA. Is kind of another way of getting those contributions in. If you already have a traditional IRA balance, then all of that money that you roll over or a portion of it would be counted as ordinary income in that year and not something that you would want to do, depending on your balance there. Do you have a point
so,
there,
Arish,
Jeff?
I've always heard that there's a limit for the Roth contribution, right? And if you're like in between a couple of numbers, then the amount that you can contribute is kind of like adjusted lower proportionally. But then you're talking about this other option with a backdoor Roth conversion that is available to people regardless of their income?
Correct. Yeah. So there's a range on where you're able to contribute into the Roth IRA. So for 2025, I mentioned if you're married filing jointly, if you're under 236,000, you can make that full contribution. But then there's a sliding scale with this. So up to 245,000, you can still make a portion of your contribution. So if you made 245,000, you could contribute $700. So there's a sliding scale. I usually recommend anywhere if you're above that amount and you have the ability of doing a backdoor Roth. It's hard to determine where you're going to end up on that scale. So I would just defer to doing this backdoor Roth contribution, and whether you made right above that at 238,000 or you made $1 million, it wouldn't really matter. You can make that backdoor Roth contribution and get that money into your Roth IRA. It's with after-tax money now. You're going to get no advantage in terms of decreasing your taxes now, but that money will then grow tax-free from here until you take it out in retirement.
So what's the point of that limit then?
If you have a traditional IRA, so let's say you had an old 401k, you rolled it into a traditional IRA, and then you wouldn't have the ability to make this Roth IRA contribution or this backdoor Roth, because then all the money that you put in, if you put 7,000 into your traditional IRA with that money, it all gets combined. And then when you roll it over, let's say there's 100,000 in there, only 7% of it or 7,000 out of the 100,000, it's taxed pro rata. And so a big portion of that would be taxed as ordinary income, as if you're taking that money out and earning it in that year. So
gotcha. Wow.
Yeah. So it's a loophole in the IRS, and it's something that they know about, but I think it's something that I'm guessing a lot of politicians take advantage of or something like that. And
you have a really low opinion of our leaders, Arish. Unbelievable. They wouldn't do that.
No, never.
I mean, some of our politicians have some really good investments that they've made. I mean, they have the foresight of it's the jealousy of Wall Street, I can assure you.
No, it's still crazy to me how they're allowed to trade, but it's something that you're able to do to get money into a Roth IRA if you're kind of over those income limits, in a good way to put money away and get that tax-free benefit. The other
any
point
thoughts on Arish,
ahead.
any thoughts on the Roth 401k versus the traditional 401k?
Yeah, I was going to switch to 401k, so that's a great transition. I mean, I think it's an awesome option. I mean, either way that you're able to get money in tax free for your retirement, I think is very beneficial. One of the advantages of an IRA is you have a little bit more control over the investments, and it's an individual retirement account, meaning that account is yours. Where when you're in a 401k, you're a participant in an employer's plan. And so I guess not as much investment options, but if you're kind of weighing the options and you're saying, okay, should I contribute X amount into my 401k or not contribute into the 401k and do the Roth IRA, I'd say use that 401k as a vehicle first, and kind of use that Roth component. I think if you're in a situation where you're able to max out your 401k, then I think kind of the Roth IRA becomes another option at that point. But both are really good ways to save tax-free for your retirement, and will go a really long way in meeting your retirement goals.
I love tax-free growth. That's awesome.
Yeah. The other thing I was gonna bring up with contribution limits was just how the 401k has switched. And so small increase. It went from 23,000 for maxing that out under age 50 to 23,500. The age 50 catch up is still the same at 7,500. So if you're above 50, you can make a total contribution of 31,000 starting in 2025. But they recently added something new. It's another catch up, which is if you're aged 60 to 63 and you're still working and participating in a 401k plan, you get a new catch up even above that age 50 catch up. So you can contribute an additional 11,250, which brings that total to 34,750. So that's something new with Secure Act 2.0. I find it interesting because if you're age 50 to 59 or 64 and above, then you can make 31,000. But if you're in that 60 to 63 range, then you can do 34,750. I don't know why they didn't let the above 64 participate in that new catch up, but it was kind of an interesting way of framing it.
Some lobbyist had a birthday that was like on one line or the other, right? So they were like, whoa. What day did you pick? Oh, let's pencil that in.
Yeah.
Now, I wouldn't guess, I wouldn't say that I know how the sausage is made behind the scenes there, but if I was
you're the one sounding skeptical.
Hey, that's what I get paid to do, baby.
There you go. But yeah, always love to talk about different contribution limits and things that have changed at the beginning of the year. If you are participating in a Roth IRA or a backdoor Roth, again, awesome opportunity to either finalize your contributions for 2024 and make them for 2025. Here in this window, I know a lot of people get bonused out at the end of the year or might still be sitting on that money. It's a great opportunity to kind of get that working for you for your retirement. And then make sure if you're above 50 or in that 60 to 63 range for the 401k, you're taking advantage of those catch-up provisions and deferring more income into your 401k.
Start early, start big, right?
Oh, yeah. So you got the Chiefs was your final prediction, Jeff?
I mean, you might as well. I think I got the Chiefs by 100. How about you?
By 100. I hope we get a little closer.
I mean, that's Travis Kelce and T Swift going to have a ceremony down there with the Lombardi Trophy if that happens, right?
It's really unfair because, I mean, this is the second year Swifties have been fans of the NFL and they're in the Super Bowl for the second straight year. I mean, they haven't gone through the pain that we've gone through.
Sometimes you just happen to pick a team that's good for several years in a row.
I guess that was a hint at your Patriots fandom.
Well, we're paying for it now, but I'm hoping Mike Vrabel really, sets us on the right path next season. And Drake May, I thought he was pretty good. I have some high hopes for this guy, but I had high hopes for Mac Jones. So maybe this
fair.
Disregard everything I'm saying.
Oh yeah. Well, appreciate the time, Jeff. It was a good episode, and we'll see what happens here in the Super Bowl.
Yes, sir. See you later.
Thank you for listening to our podcast. Remember, The views expressed are not necessarily those of Beam Wealth Advisors. All content is for educational purposes only and should not be construed as an endorsement of any third party or their views, or as a solicitation or offer to sell securities or provide investment, tax, legal, or consulting services. We believe the information presented to be reliable, but it is not guaranteed for accuracy or completeness. Investing involves risk, including the potential loss of principal. Hypothetical returns do not reflect actual trading and may not be indicative of the performance of any specific investment. Always consult with a qualified financial advisor before making any investment decisions. Past performance is not a guarantee of future results. Additional information, including management fees and expenses, is provided on our Form ADV Part 2, available upon request or at the SEC's Investment Advisor Public Disclosure website, advisorinfo.sec.gov.